Hey, we're live. It's May 2nd, 2024, and you're with us, the Rogue Traders on Deribit Live. Of course, as always, my partner Richard Hodges with me, Shane Oglow, and we've got a bit to talk about. Finally had some action in the markets, but it's interesting the way it's played out so far. So let's see, waiting for a few more people to roll into the room. Hi, Andre. I wonder how Andre's going to make fun of me today, but let's see that. May 2nd, did you know? I'm Canadian, so I always pay attention to Canadian stuff. On this day, I think it was 1670, like 350 years ago, the Hudson's Bay Company was incorporated. The Hudson's Bay Company was created by the British, and there's a long story about this company. It's still operating. It's the oldest company in North America, over 350 years. It's pretty crazy. I have a lot of fond memories of that store. Anyways, a little bit of trivia for you today. More people still rolling in, but let's get started. I got my slides up here. I'll just mention in the chat Core from Holland. If anybody is not yet a Deribit member, which is kind of unlikely, sign up on the chat. We've got our link there. You can save 10% on your fees and do us a solid. All right, so let's just head over to the slides. And what we're going to talk about today, it's funny because I put the topic together like Monday, Tuesday. I thought, okay, just hold channel until our call on Thursday. Don't break. And it's kind of broken out. It has sort of, but not really, kind of yes, no, maybe. So it's still relevant. So, of course, what we're going to talk about is relevant for any channel breakout any time. So we'll talk a little bit about it. And
we'll discuss a bit later that you're not really fully convinced that we've broken out, right?
I'm not 100% on board, no. And in fact, so what I'm going to do here is I have a poll question. Let me publish the poll question right now. And my poll question is, and you can answer later if you want after we talk about this, is Bitcoin going to go back up into its range, that 60 to 70K range? Or do you think it's going to continue to go down? Put your answer in there and we will talk about that a little bit later on. Okay, let me go back to our slides. So before we get started, the Synth Miner account, this is the account we set up exactly to the day 9 weeks ago. I mean, it feels like 9 years ago, but it was 9 weeks ago. And we set this account up with 0.0825 of a Bitcoin, which is worth about $5,200 at the time. And we decided to say, hey, let's create an account using options and let's try and beat the miners. Mine more Bitcoin than someone would if they went out and bought mining equipment and did all that stuff. And so far, we're still kicking ass. Our Bitcoin Cash is up from last week at 0.1114. Equity, as we'd expect, is down. We're down 10% from our call we had last week. The price of Bitcoin is down. Bitcoin mine, 0.019, so a 23% increase from the start. So we've increased our Bitcoin by 23%. Starting USD cash, hey, we're still up, $6,500 or so. Our annualized return is 112% if we keep going.
In dollars.
It is. In dollars, USD annualized return. Now, if we hodled that annualized return in US dollars, we'd be down about 44%. Because remember, 9 weeks ago, we bought that Bitcoin. We started the account. Same thing. 9 weeks ago, you bought Bitcoin and you're hodling, right? So let's just take a quick look at what the charts look like to make it look pretty here.
There's one number missing from there, which is like what's our annualized return in Bitcoin.
Okay.
Which last week was 494%, but today it's 235%.
Okay, fair enough. And here's our year-to-date returns in Bitcoin. Okay, again, a hodler is just going to be a straight flat line because you're just hodling and you're not doing anything. And if we look at the USD returns with synthetic miner, we're going to have those ups and downs along with the price of Bitcoin, but we're well above people who are just hodling. So that's pretty good stuff. I'm pretty happy with that. Let me jump over to the charts. And we're going to take a look at where Bitcoin's at, what it's been doing, and we're also going to talk about the breakout. Remember, today's topic should be back here somewhere. Preparing for the channel breakout. I'm just.
Only we had been prepared last week.
Yeah. Okay. I need to jump here. Let me turn off the slides here. Go to my screen share. And today I'm actually going to try to use our little whiteboard feature here, which we haven't used in a while. I wonder if I should use a black background instead of the no, because the whiteboard won't show up on a
I wouldn't get clever just yet. Yeah, practice before you do that now.
It's just a matter of clicking a button. It's really nothing.
Yeah,
but the whiteboard won't show up on it, is what I'm saying.
Many live blooper reels start with, let's just try this live in front of the audience.
Yeah, all right, fair enough. All right. So here we are. We're just slightly below the channel. Now, this is the 100-day moving average, this blue line here. We cracked below that, and it happened to be right at the point where it kept bouncing off before. Is this a false breakout? It might be. It might be. It certainly hasn't carried on with conviction. I know yesterday, sitting around watching it was pretty, pretty problematic, pretty scary. But the other thing too is we've got the 200-day EMA down in the low 50s, around 52, and that's also where the price stuck a little bit on the way up. And it's also the start of that resistance band if we go back to 2022, 2021. Now those, the deeper you go back in history, the less relevance they have. But a lot of people were saying, hey, this is the logical place for it to probably get hung up on. And I agree with that. Other than that, if it plunged to that, well, we're probably looking at, high to mid 40s. That would be logical if it went down. And we're going to talk a little bit. Richard has some information a little bit on the Hong Kong ETFs. And one of the reasons why I feel this could be a false breakout is, okay, there were a lot of outflows from ETFs, but when you break a channel, oftentimes you really run. And Bitcoin's famous for just kind of plunging and then going back up. So I think this week will tell us. I really think that the rest of this week will tell us, certainly into next week, if it's going to keep grinding down, and it might. It might. I think it's probably a 60%, 70% chance we're going to keep going down, but there's also a good chance to head back up, at least into the bottom of this range. All right, so preparing for the channel breakout. What can we do? Well, here, let me put this whiteboard thing on here. I mean, if you want to play the channel, we can say that, hey, we're in this channel. It doesn't matter if we're at the top of the range and we think, hey, it's going to go up. We're hanging around the bottom range. You think it's going to go down. We know the channel's not going to hold forever. So what can we do? Well, we can buy options, right? We can buy a call here. Oh, we can buy a put there, right? Simple stuff. You're going to pay some money. If it goes up, you make some money. If it goes down, you make some money. All right, easy peasy. But the problem with that costs money, right? Costs a lot of money, especially right now as it's pushing down around this area. I mean, premiums go through the bloody roof, right? And you're, who wants to pony up that cash? And look at what it did. It pushed down. You had to pay through the nose of those premiums. Oh, hey, guess what? Back up to 59.
And vol fell off like a rock, right?
Yeah, went from 55, 56 up to 62. Now we're down around, what are we at, 56 now? Something like that, 58?
Let me just check.
Yeah. So the problem is you can burn up a lot of cash. And it's also your timing too. You might have played this breakout, just for a few days. You might be looking more for, end of the month. You might be looking out, to June or whatever. Okay, fine. Maybe you want to layer on all three. A little bit more dangerous. But if you're going to play the breakout, a lot of people just kind of lay on the shorter term bet. Maybe it's a week or two out. Doesn't work out, they'll lay on another one. Of course, if you keep doing this week after week, you'll burn through a lot of cash. So what can we do? Well, that's easy. We can just say, look, if it's at the top of this range, if it's at the top of the range up here, and we think it's going to go up, I think, geez, you know what? I think there's a good chance this thing can make a run and maybe go up to 85. Well, we'll go ahead, and we're going to, here, let me change my color here so I can see it. We're going to go ahead, and we're going to sell some calls up here at 85. Same thing on the downside. Hey, we think it might rip down, but we don't think it's going to really go much below, 52. That's where all the support is. So we're happy to sell puts here. Nice. So what do? We just, on the top side, we created a bull call spread or a long call spread a call debit spread, however you want to call it, right? And it cost us less money. We had to pay for the long call, but we got a little bit of money for the short put. But we didn't get that much money for the short put. Why? Well, because it's further away from the money, right? Makes sense. The short put is further away, so we got less for it. But at least we reduced our costs. Maybe we reduced it by half or a third or whatever that might be. So we got in a little bit cheaper. That's nice. But what's the next thing we do? And you'll see us do this all the time. Is we'll say, okay, you know, we're pretty happy to buy this. We're at the top of the range right now. We think it's going to break out, but we don't think it's going to go above 85. So what do? Well, we're going to go over here. Let me get I'm using two screens here. And we're going to go ahead and we're going to sell two calls here. Or on the bottom side, we're going to sell two puts down there. One put was sold two puts. And what did that do? That paid for it. Now, sometimes there might be a small debit. Sometimes it might be flat. Sometimes it might be a small credit. Depends on the skew, price, strikes, all that stuff. But now we got in, basically, let's just say it's free. We've got free coverage if the range breaks, but we're only covered to a certain area. We're only going to profit, the distance between the strikes. Okay? Pretty basic stuff. Let's take it a step further. So actually, I'll leave the 1 by 2. So we leave the 2 on there. 1 by 2. What's the problem? Oops. Let me just make this a better 2. The problem with this strategy is you say, okay, well, Shane, that's all fine and dandy. But what if it rips up and goes past the 85? I've got one short call here. Or if it rips down past 52, I've got one short put that's uncovered. You know what? You're right. You're right. So what do we do to fix that? Well, pretty simple. Buy another call up here. Buy a put down here. Now I've turned it into a butterfly, a directional butterfly, or a bull butterfly, or a bearish butterfly. So we think our sentiment hasn't changed. We think it's going to go up. We think that it's probably going to get stuck around 85. But if it does blow through, we've got coverage at a higher price. All right. So that's how we kind of build out these spreads based on, it doesn't have to be a channel breakout. You might, the price might be plummeting down to 45 and you think it's going to bounce off 45. Directional butterfly, we grab this whole butterfly and stick it down here thinking we're going to bounce up. Beautiful. Love it. I think it's great. So that's one thing we can do. What's another thing we can do? All right. So we've got our position here where we want to buy a put or buy a call. But actually, let me get rid of one of these. So I'll just say, look, we're going to go ahead here and buy a put because it's more relevant right now. We think it's going to go down. Fine. Want to put, but we're super cheap. We're super cheap. We're stingy. What else can we do? Well, we looked at these spreads we can do to reduce our costs or completely pay for it. The other thing, and one of our favorite things to do, is to do a risk reversal, right? An RR, a risk reversal. And what are we doing in this case? Well, we're going to sell some calls. Let's just say we sell some calls here to pay for this put. So we're long this put. Let's say it's at 60,000 or 59 or 58, whatever it is. And maybe we're selling some 62, 64, or 65,000 calls. Now, in this case, just like the plain old debit spread, the premium we receive from selling the calls isn't going to be enough to buy the puts, is it? But it's going to reduce the cost. Well, we can do the same old thing as the 1 by 2. We can sell two calls to buy the put. That may or may not be enough to cover the whole cost. Depends on the skew, premiums, and the strikes. But you can do that. If it goes down, happy days. Your put's paying you good money. Your calls are devaluing fast. You can buy them back for cheap, let them expire, whatever. So that's sort of the. I don't want to get any further into it because we're already at 15 minutes past the hour. But that is pretty much the whole, the simple way for us to play those channel breakouts. Now, sometimes you don't get things cooperating. And I'd say right now, in a way, Bitcoin's not really cooperating because if you bought May 3rd, May 10th, puts, let's say you bought them at 62, well, they're still looking pretty good. They're still doing well. The skew is to the downside. But if you were, it always works great if there's one giant candle down, or in 2 or 3 days, it loses like 15, 20%. Beautiful. You cash in, but sometimes you got to wait because it's going to monkey around. And that's the problem. If you do this on a longer time frame, you're thinking, oh, you know what? Hey, you know what? We could be down. Why don't I put on a short term? I'll put on a medium term, and I'll put on one, October or something. Well, the price could go down for you, then back up to the channel. Unless you're convinced, if you're thinking that this thing's going to go up, and you think, you know what, Shane, by next year, this thing's going to be at $150,000 easy, no problem. Okay, maybe you want to buy a call right now. We'd probably want to do that as a synthetic covered call or something else in order to make it pay. But we don't want to get into that too much. That's just the simple strategies we've used. Richard, do you want to add anything to those spreads and the way I built out each spread and how the characteristics for the margin and the risk change for each of those?
No, I think we're going to need some better graphics. Buy you a pen or something. But we should do some nice animations because it's very, very useful stuff. This, right? And I think the 1x2 we use it a lot. I use 1x3s sometimes as well. And I sometimes use 1x3s the other way around. Like I'm short the inner leg and long 3x the outer one. So you're betting you're getting paid to bet on a massive move. Being short the 1x2 is you're essentially you're getting into a win on a moderate move for free. And just addressing Andre's question here, Butterfly will pay you on a moderate move down, but it will protect you against a massive move. Okay, so it won't pay quite as much as a 1x2, but it's safer.
I think it's worth mentioning too, and maybe this is just my personal opinion, but normally when I see people in the world talking about butterflies, they're not usually using them directionally like I just showed. These are called directional butterflies. Yeah. A lot of times people are just putting the body of the butterfly where you're selling two options close to the money or at the money, and then they're selling, then they're on the wings.
That's the iron butterfly. Iron butterfly is sell, put, and a call at the same strike, and then buy cover. And then the iron condor is that, but further apart, so you're not at the same strike. So actually, iron butterflies are quite good for overnight trading, because if you think that the daily vol is going to be less than the implied vol overnight, particularly around an FOMC meeting, for example, that we just had, where we went up to 70 vol overnight, and we're thinking, no way, right? That's a nice trade to put on, because you're paying almost nothing for your cover, and then you're getting the full onslaught of a premium for your iron butterfly at the money.
Yeah, and I don't know why I think that most people think of the butterfly as an at the money, like an iron butterfly, but that's just sort of in my conversations over the years. Most people just when they think butterfly, they think that they're not really aware of kind of a directional butterfly.
Yeah, I use iron butterflies that are in the money a little bit as well. If I'm trying to dig myself out of a hole, if I'm in the money on some puts, I currently am on a few puts in my personal synth miner account, right? So I'm selling calls at the same strike as those guys. And then my view is that if the market does recover and my calls get in trouble, then I can roll. Well, the puts I can rewrite, and the calls I can roll out, and the combined premium from that, as long as realized vols are less than implied vols, I'm going to eventually open up the gap and turn it into a condor, and then eventually get away free.
Beautiful. Yeah.
And then there's also the other one. If you're an iron butterfly, if you've got at the same strike, and then if you have to write the call below the put, that's called a guts, because it's inside out, right?
And Richard, you told me the other day that you didn't know Iron Butterfly, the band, the famous song in Ingrata and I meant to play it for you, but for us old guys, you should know this, classic rock and roll.
I wasn't that cool.
You weren't that cool. Yeah. It's a good time to mention too, if you guys want to check out the offer tab, we've got something called the Rogue Trader Gold Member Discovery Call. Hey, if you want to join us, see how we're doing this in our accounts, see how we're operating the synth mining accounts, have a chat with us every week, a couple times a month, one-on-one chats, book a call, and you can chat with me and we see if it's right for you. So please check that out, or you can always email us too at hello@roguetrader.com. Academy, and we can chat with you that way. Actually, that's a good segue. Richard, why don't we check out the Synth Miner account right now, and we'll see how that thing's cooking along. We already looked at the stats. We already know it's doing quite well, despite having Bitcoin move down about 10% since last Thursday.
Yeah, so here we go. We've so I'll just try to focus on the puts, because I've been away for a week or two. Shane, you've had to make a few adjustments. So you took some 3rd of May put spreads that were in the money, and you rolled it into 58k put spread, and a 10th of May.
Actually, I might have had to go to the 31st with some too.
I think I'm not surprised. So you went down to 54k. Very sensible. So what that's done is actually we don't like to run more than three put spreads, 3 times notional put spreads at a time, and we're currently running 6. So we've got 3 0.3 put spreads here on 31st of May. We've got 0.1 here on 17th of May, and 0.1 here on the 10th of May, and they're all quite close to the money as well. So it's all a bit threatening. And we've got this overnight one as well, which oddly I'm not that worried about. I could easily be wrong about that. So this morning, this afternoon, Shane and I just took the decision to sell 2 lots of the overnight call spread, and we're going to be doing this. We're going to be just selling this every day or every 2 days. This call spread, as waiting for 3 of these legs of the put spreads to evaporate, and once they're gone, we'll stop selling this, and we'll go back to the vanilla strategy. And the idea is we feel as if we're running a bit too much risk on the downside. We're running 6x our notional, which is twice as much as we want to do. Even so, we're only using 17% of margin, so it's not that uncomfortable. But still, we don't like to push the boat. And this 0.2 here, even right now, this 0.2 here is trading at 57, and the cover's 8. So it's called, let's say, 50 basis points. So we're talking about $230, $240 per contract. So we're buying ourselves, against this contract here, we're buying ourselves being wrong by $500. And then once this 3rd of May put spread goes out the window tomorrow morning, hopefully, then we've got 7 days of selling this against the 57 put. So $200 a day, so $230. Let's call it $250 a day, right? Over 8 days, that's $2,000. So if we carry on doing that, the market still goes down. This 57k put effectively becomes a 55k put. At which point we'll also have a load of profit on our long puts, and we'll be able to roll that position and take into a credit, and also have taken a credit from the calls. So I'm pleased about that. And then I want to show the spreadsheet of how we're doing here. Oh, so yeah, I'll just show the wallet here. Here we go. So the cash balance in the wallet is 1123. And the equity currently 1026. So the equity is down a little bit. The cash balance is at an all-time high. So we're just hoping to realize that out fairly soon. Really happy because we started with 0.025. So that's nice. And then here's the rogue traders. Here we go. Here's our little record, which you've seen already on the presentation, right? But I think the blue line on the left is the one to follow. This is us mining bitcoins, and this is way easier than buying a mining rig and hooking it up to a power source and all that nonsense. We just started with $5,000-6,000, and we're gonna. I think we'll end up mining. I don't know, probably like 0.3 of a bitcoin by the end of the year, if all goes well.
Yeah, I think that'd be a nice.
Which for pretty much zero investment, you can't really cry it, right?
Yeah.
And I was going to say one more thing. Doesn't matter.
Vladimir did make a comment. He said actually it's pretty much less for the call leg since Deribit charges you plus or minus 4 to 5 basis points.
You mean on the spread or the fee? Well, so we try and reduce the fees by trading the combos. You get a discount on your lower fee if you trade 2 legs on the combo screen, on the strategy screen.
And it has been working better lately. The last time we put combos in, we got filled
to get filled. Yeah,
quickly.
There's a little bit of liquidity coming to this now, so we always try it. If it doesn't work, we go and fill it manually. But and also another way to mitigate this is we try not to cross the spread. We try and actually just place the trades at mid and then wait to see if somebody else crosses us or the market moves and we end up being offside. It's just good discipline, right? To try not to be a taker all the time. If we ever get these accounts to the size where Deribit offer us lower fees for being a maker or even rebates for being a maker, then it's even better discipline, right? Because you get much better fills. But yeah, I think we're paying about 3.5 basis points, I think, on this account. But less on the cover because there's a maximum fee. Is it 12.5% of your premium is the maximum you'll pay in commission, regardless of what the fee comes to. But yeah, there is a bit less. But that's just part of the game. Right? We are quite happy to give up, I don't know, 20% of our profits in broker fees. I'm quite used to that after 20 years of trading. Yeah.
And in fact, 20% can be a good deal some years. Some years you like it.
But yeah, there's definitely there's that truism, isn't it? A stockbroker is somebody who goes on holiday in his yacht when the markets crash, because they make money regardless. But if you've got the appetite and the budget to set up a whole exchange, I've been through that process myself, and I can tell you it's really hard. So I think the Deribit guys deserve their 3.5 basis points.
So Ken made a comment here, and he said decisions. He said layer increasing complicated recovery trades on top of each other versus getting out and waiting. I mean, okay, I don't think this is complicated, but I do get what you're saying, because we want to be really disciplined with this. And we actually had a bit of debate on our live stream today. And of course, you can join us every day on our live stream when we make these decisions and trade the account. You can check that out on Patreon, Rogue Trader Academy. But, we weren't really sure. We're like, geez, do we want to deviate from our strategy? And do we want to sell these calls? It makes sense on other accounts to just do it without even thinking about it. But on this account, and the only reason we did, because we felt we got a little bit too much downside risk in this occasion, so we're using it as a patch. There's also sorry to interrupt you, Shane. I keep doing that. There's also this nagging feeling that this might not be a breakout on the downside. We're running out of time, but I was going to get onto the whole yen carry trade and the Hong Kong story and all that, but which I can cover off if you want. But I mean, yesterday was kind of a perfect storm, really. There was a lot of concern over the yen carry trade, as there was in 2008 when it broke down last time. And just a quick recap of that is, if you own property in Japan or assets in Japan, you can go and borrow at close to zero in yen, and then you can take your yen and go and buy dollars, and then go and earn 5% or 4.5% on treasury yields, or buy stocks in the US or whatever. And literally everyone and his dog does that, and has been doing it for the past 40 years, except for in 2008. And it's a result of the fact that Bank of Japan interest rates are super low. The interest rates in the US are normal, sort of 4.5%. Everyone says it's high, but it's just normal. And so obviously you're going to borrow yen and buy dollars, right? Because you just earn a carry. And that's a humongous trade. It's a big part of our global economy, how our global economy works. And if interest rates in the US suddenly were to plummet, or interest rates in Japan were suddenly to rise, that trade would reverse out immediately, which would cause a massive crash in US equities and a crash in Japanese property, because people would go bust and it would be carnage, right? And there was some concern, and I think there is some concern around how sustainable is this. There's also the fact that we've had ETF outflows, but I think that's just probably more to do with general market coming off, and probably also a bit of an unwinding between of hedge funds doing the Michael Saylor MicroStrategy versus short MicroStrategy versus long ETF, Bitcoin ETF trade. That's an arb trade, or a carry. It's a
a basis trade that people are doing. That unwinding will of course cause selling in Bitcoin. And there's also there was also this general risk-off feeling of, is the FOMC going to really lower rates at the end of the year, or are they backing out of it, or are they going to raise? And just that general hysteria around the FOMC, and it is just hysteria, right? Who cares? What actually, interest rates don't affect stock prices. What affects stock prices is inflation and money supply. And what the Fed is doing, in summary, in my view, is they are keeping interest rates not high but normal to give the illusion that we're not printing money, and then behind the scenes making liquidity available to the system to avoid the stock market crashing, which means basically printing money. So I don't think the story goes away. I think if we get through this period of concern, then we'll just go back to, they're going to carry on printing and stock till everything goes up. On the Hong Kong story, so we were a little concerned to see that the Hong Kong ETFs had a lackluster start. I thought I saw they only raised 11 million in the first day,
something like that.
So the thing I'll say about that is that the Hong Kong ETFs were very quickly rushed through, so they've had very little time for marketing them and selling them, through to CFAs and all the rest of it. They opened on the first day clearly lackluster because, well, nobody done any advertising and there was no pent-up demand. And then that was Tuesday, and then Wednesday was a holiday in Hong Kong, so there's been no inflows there. And then today it's the first day that they could have even had any inflows, even if they'd wanted to. And I don't think I've not found any figures yet of how that went. But my kind of assumption yesterday was we saw the market sell off, and Shane was panicking, and I was trying to ruffle smooth his feathers down, and I was saying, look, the Yanks are going to sell it and the Asians are going to buy it. That was my that was the kind of my synopsis, which kind of happened right overnight, I think.
Okay.
But I think it's one to watch, right? The Hong Kong. I think the Hong Kong ETFs are definitely one to watch, because I think there are a lot more Asians who hold Bitcoin than Americans. There are a lot more Asians, full stop, than Americans. And we have this kind of truism that Asians tend to be a bit more degenerate in the way that they trade. They're a bit more
take more risk, particularly.
They're more happy to take on risk. And so I think there may be a story unfolding there that we haven't seen yet. I mean, they may not, but
it may take some time to ramp up, but they might really start cooking. As the weeks roll on, it might just keep going and going. And if China starts instituting more capital controls, they got that wall of money we talked about before. There's a lot of money in China that it finds its way out. So,
and people in the PRC are largely not allowed to go and buy ETFs in Hong Kong. I think a select few can through various programs. I'm not an expert there, but if anything, if I know anything about the Chinese people, they are ingenious and they will find a way, right? Because they can't invest in real estate in China, they can't invest in stock. It's unreliable and full of fraud. Put the money in the bank's going to steal it. What have they got? They've got gold and Bitcoin, right? At the moment.
Yeah.
So.
Yeah, Giandre, I see you put your hand up. I don't know if you meant to do that. Of course, we can't actually bring you on in this platform, but you can,
because we haven't paid our subscription fee for the platform, so we can't bring on.
That's some enhanced level or something. I don't know how that works, but you can always just dump your question into our Q&A section, and we'll answer it there. We do have actually, there's a couple of things here. A question from Gene. Do you sell 0 day to expiry when downside risk or upside vol is interesting, or is the risk reward trading 0 DTE to negative? Yesterday vols were up 100 vols in the wings, 52, 40, 54K puts. Was that a trade you would have taken?
Yeah, if I'd seen it, yes. I maybe not right out in the wings. 100 vols sounds like it would have been like 1 or 2 delta. Probably not, right. I quite like the 20 delta strangles overnight, particularly when vols are elevated. Strictly for maximum value, you should probably do the money, probably, but and then adjust it if it's wrong. And I think, well, I think maybe a 30 or 20 delta strangle is a nice trade if you've got like a vol at 70, say, and you think the market isn't really going to do 70 vol move. My feeling would be, let's do that, and if it goes wrong, then we'll roll it out and we'll roll it into a straddle and then a strangle and then get rid of it. And also if I'm nursing a lot of put risk on the downside, that's a bit close to the money, which I am, then I'm very happy to sell at or near the money call spreads to pull in cash, just to get cash in against it all going wrong.
Yeah. No, I think that's it. That's great. We have got no more questions. So I'm just going to jump over the poll. We've just run just a little bit over time. I think we're doing better. So I'm very surprised by the poll results. And the question was, is Bitcoin going back to its 60 to 70K range, or will it continue to go down further? 64% of you said that it's going back to its range. 35% said down. I kind of thought more people would be inclined on the technical side. We broke the range, it's below its 100-day. There's some reasons to think that we might keep going down. I'm inclined to think too it's going to go back up to its range. I could be wrong, but the chart's telling us something else. So it's interesting to see what the members say there, Richard.
I'm a bit concerned to see this, because I assumed like you that it would be 70% down, and then I'd say because retail's always wrong and we'll bet against that and sell puts, right? But now I'm thinking, well, maybe I should sell calls.
Well, I think Andre did mention here in the chat that over leveraged on the short side, and people will pile in. They think it's going down. It did break technically, and man, if it goes up to 63, 64, something crazy, which isn't crazy for Bitcoin, a lot of people will get liquidated. So,
and I'm convinced. I'm mindful that I'm on a show sponsored by an exchange, but I'm convinced that there are evil people out there who look at the open interest and say, you know what, let's just push the market through that open interest and take these guys' money. I'm sure that happens, right?
Richard, let's face it. Let's just say you and I had hundreds of millions of dollars in Bitcoin. Yeah. Would we push the market around if we could?
Me, no. I'd feed the world and save animals, but I can imagine you would you'd push people around and take their money, wouldn't you?
I would be, I'd be like Dr. Evil, basically. All right, and that's all for today. It's all the time we have. Thanks again for joining us, everyone. Let's see what happens. Very interesting time. The range finally broke. It's going to be extremely interesting to see where we're at for next Thursday's call. So see you next Thursday, everyone.
All right. Thanks for coming.